So when you look at a central bank from the outside, you see this fortress.
Right.
You see this monolithic structure made of solid granite that just magically controls the economy from the top down.
Like a single giant machine.
Exactly. It looks like one unified machine pulling this giant lever labeled like the economy. But then, I mean, then you start peeling back the layers.
Oh, absolutely.
You look at the actual legal framework, and that granite fortress just completely disappears. What you're left with underneath is, well, it's a patchwork quilt.
Yeah, that is the perfect way to put it.
Right. It is this intricately stitched, sometimes heavily overlapping and, constantly evolving patchwork quilt of laws and amendments and these weird legal workarounds.
And understanding how those specific patches are stitched together, I mean, that is the ultimate cheat code for understanding how the Indian financial system actually functions.
For sure.
Because if you only look at the Reserve Bank of India Act of 1934, you were only seeing one patch.
Right. Just a tiny piece of it.
Exactly. To see the whole picture, you really have to understand how that 1934 Act interacts with the Banking Regulation Act of 1949, the Foreign Exchange Management Act, the Payment Settlement Systems Act, and like a half dozen others. They all interlock.
And today we are tearing that quilt apart to see exactly how those seams are stitched
To
together.
do it.
Because if you were listening to this right now, you are likely staring down the barrel of a major professional examination, right? You are trying to make sense of a literal mountain of regulatory text.
Which is never fun.
No, it's brutal. Specifically, you were looking at Chapter 2, right? The legal framework for reserve bank functions. So our mission today is to act as your senior analysts. We're going to unpack the heavy regulatory jargon, explore the underlying logic of these laws, and give you a structured briefing.
So you don't just memorize the text, but you actually understand the mechanics of how it all works.
Exactly. And because we know the stakes of your exam throughout this deep dive, we're going to explicitly point out the high-yield data points.
The exam traps.
Yes, the traps. When we flag a specific section or an act or a year, that is a trap examiners absolutely love to set.
So start in your notes.
Definitely. So, all right, let's start at the very beginning. Section 1, the genesis, the constitutional and historical foundations of the RBI. Where does this institution actually come from?
So to really understand the origin, you have to travel back to 1926. You have to look at the Royal Commission on Indian Currency and Finance.
Which is almost universally referred to as the Hilton-Young Commission, right?
Exactly. Yeah, the Hilton-Young Commission. They were the ones who first formally recommended the creation of a central bank for India. And the context of the 1920s is just vital here.
Because the world was completely different.
Right. The core argument the commission made was that the control of currency and the control of credit, they needed to be structurally separated from the government.
Okay, wait, let me jump in here. Because that separation of powers is like the philosophical bedrock of all central banking.
Oh, 1%.
Because before that recommendation, the government was basically just running the show directly, right? And if the entity that spends the money, meaning the government, is also the exact same entity that controls the creation of the money, you have a massive, just an unavoidable conflict of interest.
You're grading your own homework.
Right. A government facing a deficit will always, always be tempted to just print more money to cover its debts. And that inevitably leads to crippling inflation.
Which is exactly what the Hilton-Young Commission wanted to prevent.
Right.
So that recommendation sat for a few years, but then you fast forward to 1933, and you get the publication of the White Paper on Indian Constitutional Reforms.
Okay.
And this document explicitly laid out the constitutional blueprint and formally recommended the establishment of a reserve bank to take over these dual functions.
So that white paper was basically the runway for the actual legislation.
Exactly, it paved the way.
Okay, so if you are making flashcards, get your pen ready for this sequence of dates. This is a key exam takeaway. The timeline is highly testable. The Reserve Bank of India Act received the Governor General's assent on March 6, 1934.
But it didn't start right away.
Right. However, the bank did not actually commence operations until April 1st, 1935.
Yeah, that gap is important.
And here is the specific detail that examiners love to use to trip people up in multiple choice questions. The RBI did not start as a government-owned entity.
Nope.
It commenced operations as a private shareholders bank with a paid-up capital of rupees 5 crore.
Yeah, and that is a fundamental historical distinction. The initial model was heavily influenced by the Bank of England, which was also privately owned at the time.
Wow, really?
Yeah, the whole idea was to keep it free from political dictation. It was only much later, post-independence, that the intellectual tide really shifted towards state control of the financial commanding heights,
Which led to nationalization.
right, leading to the RBI being nationalized in 1949. But the true DNA of the institution, its core purpose, is found right at the beginning of the text, in the preamble to the 1934 Act.
Okay, let's unpack that preamble.
So originally, the preamble gave the RBI a very specific dual mandate. It stated the objective was to regulate the issue of banknotes and the keeping of reserves with a view to securing monetary stability in India,
Okay.
and generally to operate the currency and credit system to its advantage.
Okay, let me stop you right there. Because any student reading that original 1934 preamble today is going to realize, it absolutely doesn't match the current reality of how the RBI operates.
No, not at all.
If that preamble was the constitutional bedrock, why did it need a massive structural update in 2016? What fundamentally broke in the macroeconomic environment that made that 1934 wording totally obsolete?
Well, to understand the 2016 shift, you really have to look at the evolution of global economic crises, particularly the aftermath of the 2008 global financial crisis and the subsequent taper tantrum of 2013.
Oh man, the taper tantrum.
Yeah. The original 1934 mandate securing monetary stability and operating the credit system, it was just incredibly broad.
Too vague.
Right. In practice, it meant the RBI was using what was called a multiple indicator approach,
Okay.
meaning the central bank was trying to balance inflation, economic growth, exchange rate stability, and financial stability all at the exact same time.
Which, that sounds great in theory, but in practice, it's like trying to drive a car while looking at 5 different GPS screens that are all telling you to go in totally different directions.
Exactly.
Because if inflation is spiking, but economic growth is sluggish, the market is left just guessing which fire the RBI is going to put out first. Are they going to hike rates to fight inflation, or are they going to cut rates to boost growth?
And that uncertainty is absolute poison for an economy.
Right.
Without a single, legally defined primary objective, it became nearly impossible to anchor inflation expectations.
Because people didn't trust what the bank would do.
Exactly. If businesses and consumers don't know for certain that the central bank will aggressively fight inflation, well, they start raising prices and demanding higher wages in anticipation of future inflation.
Which just creates a self-fulfilling prophecy.
Precisely. So the legal framework absolutely had to change. The Finance Act of 2016 amended the preamble of the RBI Act.
And this wasn't just a minor tweak, right?
No, this was a paradigm shift.
Hmm.
It introduced a modern statutory monetary policy framework. Legally, the primary objective became, and I quote, maintaining price stability while keeping in mind the objective of growth.
Let's anchor this with a visual for everyone listening. Imagine an old-school balancing scale sitting on a desk. On one side, you have a heavy iron weight labeled price stability. On the other side, you have a counterweight labeled growth.
Okay, I see it.
Before the 2016 amendment, both sides were floating. They were somewhat equal in the eyes of the law, just depending on the governor's discretion at the time. The 2016 amendment took that iron weight of price stability and it legally bolted it to the desk. It defined, in absolute statutory terms, which side is the priority. You manage growth, yes, but never at the expense of price stability.
And at legal clarity, it empowers the modern inflation targeting regime. It legally binds the central bank to a specific, quantifiable goal, which we will dissect in detail when we get to the Monetary Policy Committee.
Which is coming up.
But before we leave the foundational chapters of the RBI Act, there is one highly specific subsection that serves as the legal bridge to literally every other regulatory function we are going to discuss today.
Right, you're referring to Section 1715A.
Yes, 1715A. The RBI is a statutory body, meaning it can only do what the statute explicitly allows it to do.
Right, it doesn't have inherent power.
Exactly.
Yeah.
If it's not in the RBI Act, theoretically, the RBI shouldn't be able to do it. But as the economy grew, the RBI was handed regulatory powers under dozens of other laws. So how do you prevent a massive commercial bank from taking the RBI to court and arguing, hey, your power to regulate our board of directors comes from the Banking Regulation Act, but your founding RBI Act of 1934 doesn't actually authorize you to act on behalf of the Banking Regulation Act?
Wow, okay. That would be a jurisdictional nightmare.
It would paralyze them.
Every regulatory action would just be tied up in the Supreme Court for decades. So Section 1715A is essentially the legal duct tape of our patchwork quilt.
In the duct tape, yes.
It explicitly authorizes the RBI to exercise powers and perform duties under any other law in force.
It closes the jurisdictional loophole entirely. It says that if another piece of legislation like FEMA or the Payment and Settlement Systems Act, if they give the RBI a job, the foundational 1934 Act legally permits the RBI to execute that job. It harmonizes the entire regulatory framework.
Which perfectly sets us up to dive into the actual day-to-day operations. Let's look at Section 2, General Administration and Core Banking Functions. How is this institution actually structurally governed?
Well, under Section 7 of the RBI Act, you have the Central Board.
Okay.
The statute states that the general superintendence and direction of the affairs and business of the bank are entrusted to this Central Board of Directors.
And then Section 8 details the composition of those directors, right?
Yes. The board is headed by the governor, who is assisted by a maximum of 4 deputy governors, alongside other directors who are nominated by the central government.
Okay, so that's the boardroom. But moving from the boardroom to the trading floor, what does the bank legally actually do day to day?
This is governed by Sections 17 and 18, which detail the quote-unquote banking business.
All right, let's get into it.
Section 17 is essentially the authorized business charter. It is a very long, exhaustive list of permitted operations. But for the scope of your exam, you need to isolate a few key mechanisms.
Okay, give us the key exam takeaways here.
First, Section 17 allows the RBI to accept deposits from the central and state governments, local authorities, and commercial banks.
Right.
Historically, a critical exam point is that these deposits are accepted without interest.
Yes, highlight this in your notes, everyone, because examiners love testing exceptions to rules. Traditionally, no interest is paid on these deposits.
But things change.
Right. As the economy matured, the central bank needed more sophisticated tools to manage liquidity. So you absolutely must know that the RBI can now also accept money as deposits repayable with interest from banks under what is called the Standing Deposit Facility, or the SDF.
And to understand why the SDF was legally necessary, you really have to look at the mechanics of liquidity absorption.
Okay, lay it out for us.
Traditionally, if the RBI wanted to pull excess cash out of the banking system to fight inflation, it would use a reverse repo operation.
Right. Standard tool.
But in a reverse repo, the RBI has to give the commercial banks government securities as collateral in exchange for their cash.
And what happens if the banking system is just flooded with an unprecedented amount of cash? I mean, say during demonetization or during the massive fiscal stimulus of the COVID-19 pandemic, the RBI might actually run out of government securities to offer as collateral, right?
Which is exactly the constraint they faced. The legal framework had to adapt. So the SDF was introduced as a collateral-free liquidity absorption mechanism.
Oh, wow. Collateral-free.
Yes. It allows the RBI to absorb massive amounts of excess liquidity from commercial banks and pay them interest on it, without the RBI being legally required to provide government bonds as collateral.
That's huge.
It decoupled liquidity management from the RBI's own balance sheet constraints. It's really a brilliant piece of regulatory evolution.
And alongside that, Section 17 also authorizes the RBI to deal in derivatives, conduct repos and reverse repos, and buy and sell government securities.
Right, all the standard market operations.
But the most dramatic operational power is found in the very next section.
Section 18.
Ah, yes, Section 18.
This is the emergency lever. If you're taking key exam takeaways, Section 18 is the statutory basis for the lender of last resort function. And to really grasp the gravity of Section 18, we have to just acknowledge that the entire global system of fractional reserve banking is essentially a confidence trick.
It totally is.
Banks take in short-term deposits from you and me, and they lend that money out as long-term mortgages or corporate loans.
Right.
This means if every single depositor showed up on the exact same Tuesday morning and demanded their cash back, no bank in the world, no matter how profitable they are on paper, could pay them all out.
Because the physical cash simply isn't sitting in the vault.
Exactly. It's tied up in a 20-year housing loan.
Let's walk through a practical scenario for the listeners to see how Section 18 actually works in the real world.
Good idea.
Imagine a regional commercial bank. It is fundamentally solvent. The value of the loans it has issued far exceeds the value of the deposits it holds. It is a healthy, profitable business.
Okay, healthy bank.
However, it is illiquid. Now, imagine a malicious rumor starts spreading on social media that the bank's CEO is fleeing the country. Depositors panic.
The classic bank run.
Right. Suddenly, you have thousands of people lining up outside the branches demanding their money right now. The bank quickly drains its daily cash reserves. It cannot instantly recall a 20-year mortgage to pay the panicking depositors at the teller window.
And if that bank defaults on paying its depositors, the panic doesn't stop at that single branch.
Yeah, it spreads.
It spreads to the bank across the street and then to the national banks. That is financial contagion. That is how a localized rumor triggers a systemic nationwide economic collapse.
Because the commercial bank cannot go to other commercial banks for help, because those other banks are hoarding their own cash to survive the panic.
Exactly. This is where the central bank must intervene. And Section 18 is the legal mechanism that allows it. Acting as the lender of last resort, the RBI can step in and provide emergency liquidity to that solvent but illiquid bank.
Which follows the classic economic doctrine of Walter Bagehot, right? Lend freely against good collateral at a penalty rate.
Exactly right.
So the RBI advances the cash under Section 18. The commercial bank uses that cash to pay every single depositor standing in line. Once the public sees that everyone is getting their money, the panic just evaporates.
The lines disappear.
The lines disappear, the bank survives, and systemic collapse is averted. Section 18 is the statutory safety net holding up the entire banking sector.
Now, moving from acting as the banker to commercial banks, we also have to look at how the RBI acts as the banker to the government itself.
Right.
This is governed by Sections 20, 21, and 21A. And there's a structural difference here between the central government and the state governments that is heavily, heavily tested.
Yes, make sure you clearly distinguish these sections in your notes. Sections 20 and 21 place an absolute statutory obligation on the RBI to act as the central government's banker.
It is a mandate.
Right, it is not an option. The RBI must accept monies, make payments, carry out exchange and remittance operations, and critically, they must manage the public debt of the union government.
But the relationship with the state governments is legally distinct. The RBI does not have an automatic inherent mandate to be the banker for the states.
Oh, really?
Yeah. That relationship is governed by Section 21A, which actually requires the execution of mutual statutory agreements.
So the mechanics are vital here. It requires a formal agreement entered into by the RBI and the respective state government, and to ensure transparency and accountability, these agreements are elevated to statutory status because the law mandates they must be laid before Parliament as soon as they're made.
Right.
And today, the RBI manages the banking for all state governments, but historically there were edge cases.
Well, yeah, for instance, SICM. For a long time, SICM only had an agreement with the RBI for the management of its public debt, but they kept their general banking operations totally separate.
So Section 21A is the flexible legal framework that allows for those customized state-level relationships.
Exactly. So we have covered how the RBI manages the electronic ledgers for banks and governments. But what about the physical cash in our pockets?
Right, the actual paper.
How does the central bank control the tangible money supply? That brings us to Section 3, the issue functions, the monopoly of money, which is detailed in Section 22.
This is the power that most citizens immediately associate with the central bank. Section 22 of the RBI Act confers on the Reserve Bank the sole right to issue banknotes in India.
But watch out.
Yes, this is a classic multiple-choice trap. If the question asks, does the RBI legally issue all physical currency in India? The answer is no.
It's a trick question.
The central bank has the sole right to issue banknotes, with one glaring historical exception, the 1 rupee note and all coins.
Right.
These are legally issued by the government of India, specifically the Ministry of Finance, not the RBI.
Which is why, if you look closely at a 1 rupee note, you won't see the signature of the RBI governor on it. You will see the signature of the finance secretary.
That's a great piece of church.
It's a fascinating legacy of sovereign seigniorage, the right of the sovereign ruler to mint coins. The government of India mints all coins under the Coinage Act.
However, from an operational standpoint, it would be wildly inefficient for the finance ministry to set up its own separate distribution network just for coins.
That would be absurd.
So, under Sections 38 and 39 of the RBI Act, the central bank is legally responsible for putting those government-issued coins and 1 rupee notes into circulation alongside its own banknotes.
So the RBI prints everything from Rs to and above, but it circulates everything.
Got it.
But we really need to look closer at the internal accounting architecture of this money printing operation. This brings us to Section 23.
Oh, this is fascinating.
Section 23 mandates what is essentially a Chinese wall within the central bank.
Yes. Section 23 states that the issue department, which is the specific division of the RBI that creates currency, it must be separated and kept wholly distinct from the banking department.
Totally separate.
Let's build a visual anchor for this for everyone listening, because understanding this separation is absolutely critical to understanding why our currency actually has value.
Okay, paint the picture.
Imagine the Reserve Bank as this massive cavernous vault, but right down the middle of this vault is a thick wall of bulletproof glass. There are no doors in this glass. On the left side of the glass, you have the issue department. Their only job is creating currency.
Ugh.
On the right side, you have the banking department, which conducts all the operations we just discussed. Lending to commercial banks, buying government bonds, managing state accounts.
And the law strictly dictates that these two departments cannot commingle their assets or liabilities,
Why is that?
because every single banknote created by the issue department on the left side of the glass, it must be backed by eligible assets.
Right.
According to sections 33 and 34, the issue department cannot just print money out of thin air. The currency they issue must be fully backed by assets like gold coin, gold bullion, foreign securities, or eligible rupee securities.
And this is the statutory defense against hyperinflation, right? Think about historical examples like the Weimar Republic or Zimbabwe, where central banks just endlessly printed money to pay off government debts without any underlying asset backing.
And it destroyed the value of the currency.
Completely. So the bulletproof glass of Section 23 prevents the RBI's banking department from just walking over to the issue department and saying, hey, we need to bail out 3 massive commercial banks today. Just print us 1 trillion rupees.
They can't do it.
The banking department has to manage its operations based on its own capital and reserves. It cannot raid the printing press. It forces strict accounting discipline on the sovereign.
Exactly. This is a structural safeguard.
Yeah.
Now, moving down the regulatory chain, sections 24 and 25 dictate the denominations and design of the currency.
Okay, what are the rules there?
While the RBI can legally issue notes in denominations of RS2, RS5, RS10, RS20, RS50, RS100, RS500, RS5000, and up to RS10,000.
Up to 10,000, wow. But who actually decides what the notes look like?
That's a great question. The law specifies a very clear separation of powers here. The design, the form, and the material of the banknotes are recommended by the Central Board of the RBI, but the ultimate decision rests entirely with the central government.
Which brings us to the most consequential power regarding physical currency. The concept of legal tender.
Oh, this is a big one.
Section 26 is the foundational clause here. It states that every banknote is legal tender at any place in India in payment or on account for the amount expressed therein, and it shall be guaranteed by the central government.
Right.
This means if I owe you a debt and I offer you an RBI banknote, you are legally obligated to accept it to settle that debt. But Section 26 has a massive subclause that every student of Indian economics must know intimately.
Yes. Section 26(2). This provides the legal mechanism for demonetization.
Ah, there it is.
It states that on the recommendation of the Central Board of the RBI, the central government may, by notification in the Gazette of India, declare that any series of banknotes of any denomination shall cease to be legal tender.
This is how a piece of paper that was worth 1,000 rupees on a Monday becomes literally a worthless scrap of paper on a Tuesday.
Overnight.
The central government strips it of its legal tender status. Now, what happens if your legal tender doesn't get demonetized, but it just gets accidentally put through the washing machine?
We've all been there.
Right. Section 28 deals with the recovery of lost, stolen, mutilated, or imperfect notes.
And the legal framing of Section 28 is actually brilliant from a jurisprudential standpoint,
Oh, so.
because it explicitly states that no person shall of right be entitled to recover from the central government or the RBI the value of any lost, stolen, mutilated, or imperfect currency note.
Okay, wait, I have to stop you there because a student reading that for the first time is going to think, wait, if I accidentally rip a 500 rupee note in half, the bank legally doesn't have to give me a new one.
From a strict legal standpoint, they absolutely do not.
That's wild.
And here is the philosophical reason why. A banknote is essentially a promissory note payable to the bearer. If a massive chunk of the note is missing, particularly the serial numbers or the security features, the physical proof of that promise is destroyed.
Ah, I see.
If the RBI was legally obligated to pay out on every torn fragment, fraudsters would just cut notes into quarters and demand full value for each piece.
Oh, of course they would.
So, Section 28 removes the fundamental right of the citizen to demand payment for a destroyed note.
However, the economy would grind to a halt if people were terrified of slightly tearing their money, right? So
Right.
the statute provides a mechanism.
Exactly. Section 28 allows the RBI to prescribe rules, with the previous sanction of the central government, to refund the value of mutilated notes as a matter of grace.
Grace, not right.
Right? The RBI has issued highly detailed note refund rules that dictate literally down to the square centimeter, how much of a torn note must be presented to get full value or half value.
Oh, wow, they measure it.
Yes, very strictly. But fundamentally, when the teller hands you a crisp new note for your torn one, it is a regulatory act of grace, not the fulfillment of an absolute legal right.
That distinction act of grace versus statutory right is a prime target for exam questions. Star that, underline it. Now we have to pull the RBI Act into the 21st century.
Time for the digital upgrade.
Because everything we just discussed applies to physical paper. But what about the digital future? The law had to be updated to accommodate the central bank digital currency, the CBDC.
Yeah, in 2022, the legal framework underwent a profound modernization. An amendment was passed inserting Section 22A into the RBI Act.
Section 22A.
And this section explicitly redefined the term banknote to include a note issued by the bank in digital form.
This is the statutory bedrock for the e-rupee. It essentially tells the legal system, hey, all those foundational rules and guarantees that apply to a physical piece of paper printed by the RBI, they now apply equally to a digital token sitting in a blockchain wallet on your phone.
It grants the digital currency the exact same sovereign legal tender status as physical cash.
But the drafters of the amendment were very clever, weren't they?
Very. They knew that blindly applying laws written for physical paper to digital code would create absurdities.
Right.
For instance, you can't have a mutilated digital token. It doesn't go through the washing machine. Yeah. So Section 22A explicitly exempts the digital rupee from certain physical note requirements found in the Act, preventing a situation where someone tries to file a claim for a torn digital coin because of, like, a software glitch on their phone.
It's a really targeted modernization of the statute. Okay, everyone, take a breath. We have covered the constitutional roots, the banking operations, and the physical printing of money.
That's a lot of ground.
It is. Now, we are walking out of the vault and stepping into the engine room. This is Section 4 of our analysis, the monetary policy framework. This is where the central bank actually controls the cost of money in the economy, dictating interest rates that affect literally everything from corporate expansion to your personal car loan.
And to understand the engine room, we have to return to that 2016 amendment that changed the preamble.
The scale metaphor.
Exactly. That amendment didn't just alter the overarching goals, it inserted an entirely new chapter into the RBI Act, Chapter 3F.
Okay, if you are taking notes, draw a massive circle around Chapter 3 Youth. This is the statutory basis for the Monetary Policy Committee, or the MPC, and the flexible inflation targeting framework.
Super important.
If an exam asks you where the MPC derives its legal authority, it is Chapter 3F of the RBI Act.
So let's break down the procedural mechanics of how this framework actually operates. It begins with establishing the target, which is governed by Section 45ZA.
Okay, 45ZA.
The law dictates that the central government, in consultation with the RBI, determines the inflation target. And this target is measured strictly in terms of the Consumer Price Index, or CPI.
And wait, let's explain why CPI and not the Wholesale Price Index, or WPI, which India used for a very long time, right?
Right, good point.
Because CPI measures the retail inflation that actual citizens feel when they buy milk or pay for housing. WPI measures bulk goods traded between massive corporations. A central bank's primary duty is to protect the purchasing power of the average citizen, so anchoring policy to the CPI is a much more accurate reflection of real-world economic pain.
Exactly. And the statute mandates that this inflation target be reviewed and set once every 5 years.
Every 5 years.
Currently, it is legally set at 4% with a tolerance band of plus or minus 2%, meaning the RBI is comfortable if inflation bounces between 2 and 6%. But the bullseye is always 4.
Okay, so the government legally sets the destination, but who actually steers the ship?
That is detailed in Section 45ZB, which establishes the Monetary Policy Committee.
The composition of the MPC is highly specific and frequently tested, guys. It is a 6-member committee. You have 3 internal members from the central bank, the governor of the RBI acting as the chairperson, the deputy governor in charge of monetary policy, and 1 officer of the RBI nominated by the central board.
Right, that's the internal half.
And then you have 3 external members who are appointed directly by the central government.
And here is where we must unpack the massive academic and professional discourse surrounding central bank independence.
Exactly. I have to play devil's advocate here because anyone studying central banking knows that independence from the political executive is the golden rule.
It's supposed to be.
If the government gets to appoint exactly half the seats on the committee that sets the nation's interest rates, isn't that just a legalized backdoor for political meddling?
It's a common critique.
Because what stops a government facing a tough election from pressuring its three appointees to just slash interest rates, flooding the economy with cheap credit to create a short-term artificial economic boom right before voters go to the polls?
It is the defining tension of modern central banking, really. The balance between technocratic independence and democratic accountability.
How did it work before the MPC?
Before the 2016 amendment created the MPC, the RBI governor had the ultimate sole authority to set interest rates.
Just one person.
Yes. The governor was advised by a technical committee, but at the end of the day, the governor had veto power. It was a highly centralized system. And if the governor made a miscalculation, the entire economy suffered the consequences of a single individual's judgment.
It was essentially a committee of one.
Right. So by transitioning to a six-member MPC, the law attempts to democratize the rate-setting process while insulating it from groupthink.
Okay, how do they insulate it?
Well, yes, the external members are appointed by the government, but the statute requires them to be persons of ability, integrity, and standing with knowledge and experience in economics, banking, or finance.
So they can't just appoint political hacks.
Exactly. They are typically eminent academics or macroeconomists who bring perspectives that might not exist within the internal bureaucracy of the central bank. Furthermore, they are appointed for a fixed, non-renewable term of 4 years.
Non-renewable.
That non-renewability is a crucial structural safeguard. It means an external member cannot be threatened with losing their reappointment if they vote against the government's political wishes.
They don't have to campaign for their job, so they can vote based entirely on the data. And the voting mechanics are critical here, too. Every member of the MPC gets one vote. If the vote is tied 3-3, the governor gets a second casting vote.
Right.
So in the event of an absolute deadlock between the internal technocrats and the external appointees, the institutional view of the RBI legally prevails.
It is a meticulously designed system of checks and balances. And Section 45ZJ ensures that the committee isn't just an advisory board. It makes the MPC's decision legally binding on the RBI.
So the RBI has to listen to them.
Yes, the central bank cannot ignore the committee's vote. It must execute the policy rate decided by the majority. Furthermore, Section 45ZK mandates transparency and frequency. The MPC must meet at least 4 times a year, though in practice they usually meet bi-monthly to maintain a tight grip on evolving macroeconomic conditions.
And the accountability doesn't stop when the meeting ends, does it?
No, not at all.
The statute enforces radical transparency. Within 14 days of the meeting, the RBI is legally required to publish the minutes. And these minutes aren't just like a vague summary. They must detail exactly how each of the 6 members voted and provide the detailed rationale for their vote. If a member dissented, the market gets to read exactly why.
But the ultimate accountability mechanism is what happens if the RBI actually fails to meet the targets set by the government.
Oh, right. What is the penalty?
The legal framework specifies that if average inflation breaches the tolerance band, meaning it stays above 6% or below 2% for 3 consecutive quarters, it constitutes a statutory failure of the monetary policy framework.
3 consecutive quarters. Mark that down. And if that happens, the RBI cannot just shrug it off.
No, they have to answer for it.
They are legally compelled to submit a formal report to the central government. This report must explain exactly why they failed, detail the remedial actions they are currently taking to fix it, and provide an estimated time frame within which inflation will be brought back to the 4% target. It is a highly structured legal framework designed to keep inflation under control without crushing economic growth, and to ensure the central bank remains accountable to the public mandate.
All right, let's transition out of the engine room and into the vault, where the sovereign's wealth and borders are managed.
Let's do it.
Section 5 of our analysis, managing the sovereign's wallet, public debt, and foreign exchange. We touched on this earlier when we established that the RBI acts as the government's banker. But the actual gritty mechanics of managing the government's massive debt pile are governed by a specific, dedicated statute.
Which is?
The Government Securities Act, 2006, or the GS Act.
And for decades prior to this, the system was governed by the Public Debt Act of 1944, right? But as financial markets modernized, that 1944 law became archaic.
Completely outdated.
The GS Act of 2006 was enacted to replace it, aiming to consolidate and fundamentally amend the laws relating to government securities and their management by the RBI. Section 31 of the GS Act explicitly details this legal transition, repealing the old law.
And the GS Act confers some incredibly robust statutory powers on the RBI to ensure the smooth, uninterrupted functioning of the government bond market.
Because the bond market is basically the circulatory system of government finance.
Exactly. If it freezes, the government cannot fund hospitals, highways, or the military. So the RBI is given sweeping powers to resolve friction. A prime example is Section 12.
If you are looking for a highly specific, testable mechanism, guys, this is it. Section 12 allows the RBI to determine the title to a government security if there is any doubt.
Right.
Imagine two massive institutional investors are locked in a complex legal dispute over who actually owns a specific block of government bonds after, say, a corporate merger goes wrong. Normally, that dispute would drag through the civil courts for years.
Wherever, yeah.
Section 12 gives the RBI the statutory power to step in, examine the evidence, and make a binding determination on who holds the title.
And to protect the RBI from being paralyzed while performing these critical duties, the statute includes Section 18. This is a fascinating clause.
What does Section 18 do?
It grants the RBI broad immunity, essentially stating that no order made by the RBI under the GS Act can be called into question by any civil court.
Wow. But think about the systemic logic behind that immunity. Imagine if every time the government issued new debt to fund the fiscal deficit, a disgruntled citizen or a rival corporation could file a civil suit and get a judge to issue a temporary injunction halting the bond sale.
It would be chaos.
The entire machinery of sovereign finance would grind to a halt. The government would default on its obligations. Section 18 ensures that the financial gears keep turning, prioritizing sovereign financial stability over individual civil litigation delays.
Now let's move from managing domestic rupee debt to managing foreign borders. We were talking about foreign exchange, which is governed by FEMA, the Foreign Exchange Management Act of 1999.
To truly understand the legal architecture of FEMA, you cannot just memorize the text. You must understand the historical trauma that birthed it.
Yes, the context is everything here.
FEMA replaced a law called FARA, the Foreign Exchange Regulation Act of 1973. Notice the critical difference in the title: regulation versus management.
Right. FARA was a draconian, almost punitive piece of legislation born in an era where India faced severe, chronic shortages of foreign exchange.
Dollars were scarce.
The country barely had enough dollars to import essential oil and machinery. Consequently, the legal philosophy of FARA was one of intense conservation and suspicion. Under FARA, almost every single foreign exchange transaction was strictly prohibited unless you had specific prior permission from the RBI.
That sounds exhausting.
It was. Furthermore, it treated violations of foreign exchange rules as criminal offenses, leading to arrests and imprisonment. It treated every businessman who needed to pay a foreign supplier like a potential smuggler.
But then the 1991 balance of payments crisis hit, right? India was literally days away from defaulting on its external debt. The economy was forced to open up and liberalize. Suddenly, Indian companies were integrating with global supply chains.
But they were still stuck with FARA.
Right. But they were still shackled by FARA. Treating businessmen like criminals for technical paperwork errors was choking the very external trade the country desperately needed to grow. The legal framework was fundamentally incompatible with a liberalized economy.
Hence the enactment of FEMA in 1999. The entire legal philosophy shifted from policing and conserving scarce forex to actively facilitating external trade and payments and promoting the orderly development and maintenance of the foreign exchange market in India.
A total 180.
The default assumption shifted from everything is prohibited to current account transactions are generally permitted.
So under the FEMA architecture, Section 10 is the core operational clause for the RBI. It gives the central bank the statutory power to authorize dealers, these are your authorized persons like major commercial banks or full-fledged money changers, to deal in foreign exchange or foreign securities.
Right, they hand out the licenses.
The RBI issues the licenses that allow the forex market to function. And just as importantly, Section 10 gives the RBI the power to revoke that authorization in the public interest or if the dealer continually violates the rules.
But what happens when someone actually breaks those rules? This is a highly testable distinction regarding jurisdictions. If an entity contravenes the provisions of FEMA, who actually penalizes them?
Oh, this is a massive trap for students. Pay attention here. Because we are studying the RBI, your instinct will be to say the RBI adjudicates FEMA violations.
Which is wrong.
That's incorrect. Section 13 explicitly states that contraventions of FEMA are adjudicated by the Directorate of Enforcement, the ED, not the RBI.
Right, the ED.
The ED is the specialized agency tasked with investigating and penalizing these violations. However, the RBI does possess a very specific complementary power under Section 15.
Yes. Section 15 grants the RBI the statutory power to compound certain contraventions. To understand the difference between adjudication under Section 13 and compounding under Section 15, we really need to look at a practical analogy.
Let's use a traffic violation to make the legal mechanics crystal clear.
Perfect.
Adjudication by the ED is like going to a full criminal trial for a major traffic offense. You are dragged into court, lawyers are hired, prosecutors present evidence, a judge scrutinizes the facts, and if you are found guilty, you are hit with a massive penalty or even jail time.
High stakes.
It is adversarial, heavily protracted, and incredibly expensive for both the state and the citizen. The ED utilizes this for serious violations like money laundering or massive intentional hawala operations.
On the other hand, compounding by the RBI is like accidentally running a red light, getting caught by a traffic camera, and receiving a ticket in the mail.
Right.
You realize you made a technical error. Instead of fighting it in court for 2 years, you admit the violation, log online, and pay a predetermined standardized fine to settle the matter immediately. The case is closed without any further legal proceedings.
So under Section 15, the RBI allows businesses to voluntarily admit to technical or administrative breaches of FEMA, like filing a form 30 days late or a slight delay in repatriating export proceeds.
Minor stuff.
Right. The business applies for compounding. The RBI assesses a penalty based on a transparent matrix. The business pays it, and the legal friction is instantly removed. It saves corporations from years of paralyzing litigation and prevents the ED's investigative pipelines from being clogged with minor paperwork errors.
Exactly. It's a pragmatic mechanism for voluntary compliance and rapid resolution, provided the contravention doesn't involve serious fraudulent intent.
Makes sense.
So we've covered the macro environment, the creation of money, the anchoring of inflation, the management of sovereign debt, and the regulation of foreign borders. Now we must zoom in on the actual institutions holding your personal savings.
The banks themselves.
This brings us to Section 6, the watchdog banking regulation and supervision. We're talking about the Banking Regulation Act of 1949, the BR Act.
We mentioned right at the beginning that the RBI Act of 1934 creates the central bank, but it is the BR Act of 1949 that gives it its regulatory teeth.
Oh, definitely.
If the RBI Act is the blueprint of the fortress, the BR Act is the arsenal of weapons the central bank uses to actually police the banking sector.
And to understand how the RBI wields these weapons, you must understand the foundational philosophy embedded in Section 5CA.
Section 5CA, okay.
This section provides the legal definition of banking policy. It states that any policy determined by the RBI must be specified in the interest of the banking system, monetary stability, or sound economic growth. But crucially, it mandates that the RBI must have due regard to the interests of the depositors, the volume of deposits and other resources of the bank, and the need for equitable allocation and the efficient use of these deposits and resources.
That is a statutory mandate that demands a near impossible balancing act.
It's incredibly tough.
Because the RBI has to encourage banks to lend aggressively to spur economic growth, while simultaneously ensuring that the banks don't take risks that could wipe out the life savings of the depositors. To enforce that safety, the BR Act grants the RBI an escalating ladder of incredible control over the management and operations of any commercial bank.
And this is a sequence of powers that examiners test relentlessly because they form the absolute core of bank supervision.
So let's walk up the ladder.
We will walk up the ladder of intervention.
Yeah.
First, you have Section 35B. This gives the RBI the power to approve the appointment, reappointment, or termination of top executives like the chairman or managing director of a bank.
So a commercial bank cannot simply hire whomever they want to run the institution.
No, the RBI holds a statutory veto over the executive suite.
Okay, moving up the ladder. What if a bank is struggling and the RBI feels the board of directors lacks the expertise to guide it through a crisis? The RBI doesn't have to just sit back and watch, do they?
No. Under Section 36AB, the central bank has the legal authority to unilaterally appoint additional directors to a bank's board to strengthen its oversight and inject specific expertise.
But what if an executive is actively causing harm? What if a CEO is aggressively pushing reckless lending practices that threaten the bank's solvency?
Then we escalate again. Under Section 36AA, the RBI possesses the legal power to forcibly remove managerial and other persons from office. They can legally fire the CEO of a private commercial bank if it is necessary to secure the proper management of the bank.
Wow. And finally, the top of the ladder, the nuclear option. What if the entire board of directors is complicit in fraud or so deeply incompetent that the entire institution is on the verge of collapse.
Under Section 36 ACA, the RBI can supersede the entire board of directors of a banking company.
A whole board.
Yes, they legally evict the entire governance structure and appoint an administrator to take total control of the bank.
Let's contextualize this with a robust metaphor to ensure you grasp the escalating nature of these interventions.
Okay, what do you have in mind?
Picture the RBI not just as a financial regulator sitting behind a desk, but as an elite team of structural engineers responsible for inspecting a massive skyscraper. The skyscraper represents a commercial bank. The thousands of people working inside are the depositors?
I like this. The routine mandatory safety inspections are conducted under Section 35 of the BR Act. This gives the RBI the power to inspect the books and accounts of any bank. The RBI engineers walk through the building, checking the stress points on the steel beams, looking for microfractures in the foundation.
Right, and if the engineers find a fracture, perhaps they discover the bank is aggressively lending to a highly volatile, over-leveraged sector like commercial real estate. They don't just issue a fine and walk away.
No, they act.
They use operational controls. Section 21 allows the RBI to dictate policy regarding advances. The RBI can legally order the bank. You are prohibited from issuing any new loans to the commercial real estate sector until your balance sheet improves. They restrict the load on the weakened structural beams.
And if the building manager, meaning the CEO, ignores the cracks and tries to sneak more heavy equipment onto the weakened floors, the RBI uses Section 36 DLA to just fire the building manager.
Boom. Fired.
And if the situation deteriorates to the point where the entire foundation is rotting and the skyscraper is at imminent risk of a catastrophic collapse that could bring down the adjacent buildings, which represents systemic contagion, the RBI deploys Section 36 ACA.
The nuclear option.
They don't just watch it fall. They legally seize the skyscraper, evict the management, take over the control room, and desperately attempt to brace the structure to protect the people inside.
And speaking of bracing collapsing structures, we have to examine one of the most critical legal evolutions in recent Indian banking history, the 2017 amendment to the BR Act regarding insolvency resolution.
Yes, Sections 35AA and 35AB. If you want to understand how India tackled the massive non-performing asset, or NPA crisis, this is the legal mechanism.
For context, prior to 2017, the Indian banking system was suffocating under a mountain of bad loans issued to massive corporate conglomerates.
The balance sheets were terrible.
These conglomerates had defaulted, but banks were incredibly hesitant to push them into formal bankruptcy proceedings. Sometimes they hoped the economy would recover and the loans would become good again, or sometimes there was intense political or corporate pressure to evergreen the loans.
Meaning issuing new loans just so the company could pay the interest on the old loans, which hides the true rot on the balance sheet.
Exactly. The system was paralyzed, and the central bank was watching the banks bleed capital. So, Parliament intervened with the 2017 amendment. It empowered the central government to authorize the RBI to issue directions to any banking company to initiate insolvency resolution processes against defaulting borrowers under the newly minted Insolvency and Bankruptcy Code, the IBC.
This was a revolutionary shift in regulatory power.
Yeah.
The RBI could essentially audit a bank's books, point to a massive defaulting corporate loan that the bank had been hiding or ignoring, and legally mandate the bank. You will take this corporate defaulter to bankruptcy court immediately, or you will face severe regulatory sanctions.
It broke the paralysis.
It did. It forced the banks to finally clean up their balance sheets by dragging the largest defaulters into a structured resolution process.
And as a final layer of regulatory armor, the BR Act contains Section 35A. This is the all-powerful omnibus clause. It grants the RBI the power to issue directions to banks in the public interest or to prevent the affairs of any bank from being conducted in a manner detrimental to the interests of the depositors.
It's the catch-all.
It is a broad, sweeping power that ensures the RBI is never caught flat-footed. If a completely novel crisis emerges that isn't perfectly detailed in another specific section, Section 35A allows the central bank to act swiftly and decisively to protect the system.
So that comprehensive framework covers traditional commercial banks. But as any analyst knows, the financial ecosystem is vastly more complex than just high street banks. Millions of transactions and loans occurred entirely outside that traditional structure.
Which brings us to Section 7. Beyond traditional banks, NBFCs, and cooperatives. Let's tackle the shadow banks first. What happens when an institution acts like a bank, lends money like a bank, accepts certain types of funds like a bank, but fundamentally does not hold a traditional banking license under the BR Act.
We are talking about non-banking financial companies, or NBFCs.
Right.
For a very long time in India's economic history, NBFCs operated under a regulatory regime that was significantly lighter than that of commercial banks.
Why was that?
They were seen as essential vehicles for reaching underbanked populations, providing vehicle loans in rural areas, or niche financing for small businesses that massive commercial banks just ignored. Because they didn't accept traditional demand deposits from retail customers in the same way, the systemic risk was perceived to be lower.
But the shadow banking sector grew exponentially, didn't it? These NBFCs became massive, highly interconnected financial behemoths. They were borrowing heavily from mutual funds and traditional commercial banks to fund their lending.
So the risk profile fundamentally changed.
Exactly. If a massive NBFC collapsed, it wouldn't just wipe out its own shareholders. It would default on the billions it owed to the commercial banks, potentially triggering a systemic banking crisis.
The realization of this interconnected risk forced a widening of the regulatory net. The foundational legal framework for NBFCs is located in Chapter 3B of the RBI Act. If you need a key exam takeaway, isolate Section 45IA.
Write that down, Section 45IA.
This is the regulatory entry gate. It strictly mandates that no NBFC can commence or carry on the business of a non-banking financial institution without obtaining a formal certificate of registration from the RBI and without maintaining a specified, legally mandated net-owned fund.
It essentially says you cannot operate in the shadows anymore. You must register and you must have skin in the game.
Exactly.
But registration wasn't enough, was it? Around 2018 and 2019, the Indian economy faced severe stress in the NBFC sector, highlighted by the spectacular collapse of IL&FS, which was a massive infrastructure financing NBFC.
There was a huge wake-up call.
That crisis exposed a glaring weakness in the RBI's toolkit. The central bank did not have the same surgical powers to resolve a failing NBFC that it had for a failing commercial bank under the BR Act.
The government realized the RBI was trying to put out a massive fire with a garden hose. So the Finance Act of 2019 heavily upgraded the RBI's statutory arsenal regarding NBFCs, aligning their powers much more closely with the BR Act.
We see the exact same themes of escalating control repeating here. Section 45ID was introduced, allowing the RBI to remove directors from an NBFC if they are acting detrimentally.
Right.
Section 45IE was brought in, allowing the RBI to completely supersede the board of directors of an NBFC in the public interest or to protect financial stability.
But the most innovative and critical upgrade was Section 45MBA.
45MBA.
This section granted the RBI highly specialized rapid resolution power specifically for NBFCs. Instead of letting a massive shadow bank collapse into a chaotic years-long bankruptcy process that would destroy value and trigger panic, Section 45MBA allows the RBI to proactively resolve the entity.
How does that work?
The RBI can legally enforce the amalgamation of the failing NBFC with a healthy institution, dynamically reconstruct the company, or even split it up into viable and non-viable pieces.
Most importantly, Section 45MBA allows the RBI to establish what is known as a bridge institution. Let's break down how that mechanism works. Imagine a massive NBFC that finances critical infrastructure projects across the country is on the brink of collapse due to toxic loans on one side of its business.
Okay.
If it goes bankrupt, thousands of viable infrastructure projects halt overnight. The RBI can use Section 45MBA to create a temporary government-backed bridge institution. They legally sever the healthy, critical assets of the failing NBFC and transfer them into the bridge institution to keep the economy functioning, while leaving the toxic, rotting assets behind in the old entity to be liquidated.
It is financial triage, authorized by statute. It is the structural engineer taking over the skyscraper, but this time the skyscraper is an NBFC.
Exactly. Now let's pivot from the shadow banks to perhaps the most legally complex and politically sensitive category in the Indian financial system, the cooperative conundrum.
Oh boy. Cooperative banks are the lifeblood of India's rural and semi-urban economy. They were historically created with a noble purpose, to pool local resources and provide accessible credit to agriculture, local artisans, and small community businesses, bypassing the exploitative local moneylenders.
But from a purely legal and regulatory standpoint, they have been an absolute nightmare.
A total mess.
And it all stems from an issue known as dual control.
To understand dual control, we have to look at the Constitution of India.
Okay, Article 246, right.
Under Article 246, legislative powers are divided between the union government and the state governments. The incorporation, management, regulation, and winding up of cooperative societies is explicitly listed as a state subject.
So it falls to the state level.
It falls entirely under the jurisdiction of the Registrar of Cooperative Societies for each individual state government. However, the business of banking is explicitly a union subject, falling under the jurisdiction of the central government and, by extension, the RBI.
So when a cooperative society decides to start accepting deposits and acting like a bank, you create a massive jurisdictional collision.
Exactly.
You end up with a system where the RBI regulated the financial, banking functions, dictating capital adequacy ratios, loan provisioning, and interest rates. But the state governments controlled the governance functions, the management, the election of the board of directors, and the auditing.
Which created a catastrophic regulatory blind spot. Let's look at a practical and unfortunately common scenario.
Walk us through it.
Imagine a state cooperative bank where the board of directors, deeply connected to local state politicians, starts aggressively issuing massive, unsecured loans to their political allies and shell companies. The loans immediately turn bad. The RBI, conducting its banking supervision, sees the financial metrics cratering. They see the bank speeding toward a cliff.
But because of dual control, the RBI couldn't just grab the steering wheel. If they were dealing with the commercial bank under the BR Act, they would use Section 36 ATA to fire the corrupt CEO, or Section 36 ACA to supersede the board.
But they couldn't.
Because the management of a cooperative was a state subject, the RBI legally could not remove the corrupt management. They had to petition the state registrar of cooperative societies to intervene.
And if the state registrar was politically aligned with the corrupt board, they would simply stall or refuse to act.
Wow.
The RBI was legally paralyzed while the corrupt management continued to loot the bank. This inevitably led to severe, localized governance failures where ordinary retail depositors lost their entire life savings. The collapse of institutions like PMC Bank highlighted that the dual control framework was structurally fatally flawed and dangerous to the public.
The situation demanded a drastic legal intervention, and it arrived recently. The Banking Regulation Amendment Act 2020. This is a massive structural shift in the legal framework and a prime target for examination questions, so pay attention here.
The 2020 amendment fundamentally shattered the paralyzing friction of dual control. It amended Section 56 of the BR Act, which governs the application of the Act to cooperative societies.
What did the amendment do exactly?
Essentially, it applied the major aggressive governance sections of the BR Act directly to cooperative banks, bypassing the state's exclusive control over management.
For example, it applied Sections 10, 10A, and 35B to cooperative banks. This granted the RBI direct statutory control over the qualifications, appointment, and removal of the management. A cooperative bank could no longer hide behind state politicians to protect an incompetent CEO.
But the most vital addition was the application of Section 36A.
3 A's.
Yes, Section 36A explicitly allows the RBI to supersede the board of directors of a state cooperative bank for a period of up to 5 years in order to protect the interests of the depositors.
Up to 5 years.
The law states they must do it in consultation with the relevant state government, but make no mistake. The RBI now possesses the clear statutory legal mechanism to intervene directly and forcefully in the governance of a failing cooperative.
Furthermore, the amendment tightened the net on basic corporate identity. Sections 49B and 49C now require a cooperative bank to secure a formal no-objection certificate from the RBI before it can even legally change its name or alter its foundational bylaws.
The philosophical shift is profound here. The law now dictates that if you are taking deposits from the general public, the source of your incorporation, whether you are a massive corporate commercial entity or a local state-level cooperative, it is irrelevant.
Because you have the public's money.
Exactly. You are holding the public's money, and therefore you are subject to the stringent, unyielding oversight of the central bank's management controls.
It is a vital, long overdue protection for retail depositors. All right, we have navigated the densest parts of the regulatory forest. We are nearing the final lap of our analysis.
Almost there.
Section 8. Markets, payments, and consumer protection. We have spent the last hour talking about how the RBI regulates the institutions holding the money. Now, we must examine how the law regulates the actual plumbing network, the markets where money is traded, and the digital pipes through which it flows.
Let's begin with the wholesale financial markets. The RBI is not just a policeman. It is legally mandated to be a market maker and a developer of financial infrastructure.
Right.
As the Indian economy integrated globally, the financial markets became vastly more sophisticated. We moved beyond simple loans into complex derivatives, but the legal framework was lagging behind the financial engineering. So in 2007, Chapter 3DD was added to the RBI Act to explicitly grant the RBI regulatory authority over derivatives, money market instruments, and securities.
If you need statutory definitions, they are anchored here. Section 45U legally defines what constitutes a derivative, a money market instrument, and a security in the Indian context.
It's the dictionary for these instruments.
If a legal dispute arises over the nature of an interest rate swap or a complex forward rate agreement, the courts look to Section 45U. And Section 45W gives the RBI the broad, overarching power to determine the policy relating to these markets and to issue binding directions to all agencies dealing in these instruments.
But the true masterpiece of legal engineering in this chapter is Section 45V.
Oh, this is a great one.
To appreciate it, you have to understand a fundamental quirk of contract law. For centuries, under the Indian Contract Act, agreements that were essentially bets on an uncertain future event were classified as wagers.
Wagers.
And wagers are legally void and unenforceable in a court of law.
So if a corporate treasurer buys a complex currency derivative to hedge against the rupee falling, a strict interpretation of older contract law might view that derivative not as a legitimate financial hedge, but merely as a speculative gamble.
A wager on the future price of the currency.
Right. And if it's classified as a wager, the contract is void. The bank that sold the derivative could simply refuse to pay out when the currency falls, and the corporation would have no legal recourse in court.
Which would instantly destroy a multi-billion-dollar derivatives market. No institution will trade derivatives if the contracts are legally unenforceable.
Exactly.
Section 45V solves this existential threat elegantly. It explicitly states that transactions in derivatives shall be valid and legally enforceable, superseding any other law, as long as at least one party to the transaction is the RBI, a scheduled bank, or another agency regulated under the Act.
It surgically carves out regulated financial derivatives from the definition of gambling, providing the absolute legal certainty required for a modern wholesale market to function.
It's brilliant statutory drafting. Now let's move from the complex wholesale derivative markets of institutional finance to the retail transactions that you and I make every single day. We are talking about the Payment and Settlement Systems Act of 2007, universally known as the PSS Act.
This is arguably one of the most consequential and forward-looking pieces of legislation in the modern Indian financial sector. It was enacted just before the massive explosion of smartphones and digital finance.
They timed it perfectly.
The PSS Act designates the RBI as the absolute, undisputed authority for the regulation and supervision of all payment systems in India. Let's use our final visual anchor. Think about your daily life. Every single time you scan a QR code at a local tea stall, every time you load a digital wallet, every time you send money instantly to a friend via UPI, or even when you swipe a traditional credit card.
All of it.
The data, the encryption, and the actual transfer of funds flow through a massive invisible network of digital pipes. Those pipes were authorized, built, and are currently aggressively inspected and regulated under the authority of the PSS Act of 2007.
Specifically, Section 4 of the PSS Act is the ultimate gatekeeper. It mandates that no person can commence or operate a payment system in India without formal authorization issued by the RBI.
So you can't just build an app.
You cannot simply write a clever piece of payment software and connect it to the banking system. You must pass the RBI's stringent security and capitalization requirements.
And if a payment aggregator violates those security protocols or compromises user data, Section 8 gives the RBI the power to instantly revoke that authorization, shutting off their access to the pipes.
Turning off the tap.
Furthermore, Chapter 4 of the Act grants the RBI vast powers to audit, inspect, enter the premises, and demand raw data from any payment system participant. It is the legal mechanism that allows the RBI to ensure that when you hit send on your phone, the money actually gets where it's going securely, instantly, and without systemic failure.
Which perfectly segues into our final analytical topic, consumer protection. The RBI regulates the banks and the payment pipes, but what happens when those systems fail the individual consumer?
That's the real question.
Where do you go when a bank missells you a product, or a digital payment fails, but the money is debited from your account and the customer service hotline ignores you?
Historically, the grievance redressal architecture was fragmented and just deeply frustrating. The RBI managed 3 separate distinct ombudsman schemes. You had one for commercial banks, one for NBFCs, and a newly created one for digital transactions.
It was too complicated.
If a consumer had a complex issue, say a failed transaction involving an NBFC wallet linked to a commercial bank account, They had to navigate a bureaucratic maze to figure out which specific ombudsman actually had jurisdiction over their complaint. It was inefficient and defeated the purpose of consumer protection.
Recognizing this friction, the RBI executed a major structural overhaul. In 2021, they launched the Reserve Bank Integrated Ombudsman Scheme, or RBIOS. It operates on a simple, powerful philosophy: one nation, one ombudsman.
It unified the grievance redressal mechanism across banks, MBFCs, and payment system participants into a single centralized portal and a single point of contact.
So much easier.
The consumer no longer has to understand the jurisdictional nuances of the BR Act versus the PSS Act. They simply file their grievance centrally, and the RBI's internal architecture routes it to the correct adjudicator. It radically simplified the process and lowered the barrier for the end consumer to seek justice against massive financial institutions.
Beyond just acting as a regulator and a referee for complaints, we must conclude by noting that the RBI also possesses broad developmental roles codified in law, aimed at building the institutional capacity of the Indian economy.
Yes, that's important.
For instance, Section 17(8)(a) allows the RBI to actively promote and establish financial institutions. Throughout its history, the RBI has used this power to incubate critical developmental entities like NABARD for Agriculture, the National Housing Bank for Real Estate, and the Deposit Insurance and Credit Guarantee Corporation to protect retail deposits.
And Section 54 legally mandates the RBI to maintain an expert staff specifically to study rural credit and development, ensuring that the central bank doesn't just focus on the urban corporate sector. They also hold specific oversight and developmental mandates under the MSME Development Act of 2006 to ensure credit flows to small businesses, and the Factoring Regulation Act of 2011 to manage working capital bottlenecks.
And as a final, highly technical point that examiners might test to see if you are completely up to date, the regulation of housing finance companies, or HFCs.
Okay, what happened with HFCs?
For a long time, HFCs were regulated by the National Housing Bank. However, recognizing that HFCs function very similarly to large shadow banks,
Yeah.
the regulatory framework was consolidated.
Right.
Via the 2019 amendments to the National Housing Bank Act, the regulatory oversight of HFCs was transferred back directly to the RBI. HFCs are now treated as a specific category of NBFCs for regulatory purposes.
It is a perfect example of the ongoing dynamic consolidation of regulatory oversight under the central bank's umbrella, designed to close loopholes and prevent regulatory arbitrage. Okay, let's take a massive step back. We have unpacked a truly staggering volume of legal frameworks over the last hour. We started by unearthing the 1934 constitutional origins and the critical shift to inflation targeting in 2016.
We covered a lot.
We navigated the bulletproof glass of the Chinese wall, separating currency printing from banking operations. We decoded the complex democratic mechanics of the Monetary Policy Committee under Chapter 3F. We explored how the GS Act manages sovereign debt and how FEMA shifted the paradigm from policing foreign exchange to managing it.
Then the banks.
Right. We inspected the structural integrity of banks under the escalating powers of the BR Act, tackled the unique crises of shadow banks and dual control cooperatives, and finally mapped the digital pipes of the PSS Act and the unified consumer protection of the RBIOS.
It is an immense amount of legal and economic data. But I urge you, as you review this material, return to the quilt metaphor we started with. Do not simply try to memorize the section numbers in isolation. A section number is just a patch. You must understand why that patch was sewn into the law. Understand the historical trauma of the 1991 crisis that birthed FEMA. Understand the paralyzing bank runs that necessitated the lender of last resort powers in Section 18. Grasp the devastating governance failures of dual control that forced the 2020 amendment for cooperatives.
Exactly. Because when you understand the economic crisis or the systemic friction that caused a law to be written, the legal jargon suddenly makes perfect logical sense. Understanding this massive framework isn't just about passing a professional exam. It is about understanding the fundamental source code of India's entire financial system. You are learning how the machine is actually built.
And as we close this deep dive, I want to leave you with a final forward-looking question to mull over as you continue your studies. We have spent this entire hour discussing how the RBI regulates physical banks with boards of directors, physical paper currency printed and secure facilities, and centralized digital payment systems operated by registered corporations located strictly within India's legal jurisdiction.
But the technology of money is evolving faster than the law, isn't it? We are currently witnessing the explosion of decentralized finance, or DeFi, and massive borderless global crypto networks.
Yes. And these decentralized networks do not have a CEO that the RBI can fire under Section 36 ACA. They do not have a centralized board of directors that the RBI can supersede under Section 36 ACA.
Because they're decentralized.
Right, the bank doesn't exist in a skyscraper. It exists entirely as open source code running simultaneously on 10,000 computers spread across 50 different sovereign nations. It does not neatly fit into any single geographical jurisdiction, and it certainly does not fit into the definitions of a payment system under the 2007 PSS Act or a banking company under the 1949 BR Act.
So here is the question for you to take away. How will the legal framework of central banking adapt to this reality? When the financial system goes entirely decentralized, will we need to tear up this entire patchwork quilt and write an entirely new global legal paradigm? Or can the foundational philosophical principles embedded in the 1934 RBI Act be stretched, amended, and reinterpreted to cover the decentralized, blockchain-based financial systems of 2030?
It is a fascinating, unresolved question.
And it is one that the next generation of financial analysts, policymakers, and regulators, meaning you, the listener, will likely have to solve in your careers. Thank you for joining us on this incredibly dense, rigorous, but essential deep dive. Go review your notes, connect the dots between these statutes, remember the why behind the laws, and go absolutely ace that exam.